Hello, everyone. This is Shoshana Zatz from the California Institute for Behavioral Health Solutions. This is the Small County Fiscal TA webinar, and we welcome you to join us in talking with Mike Geis, who is on the line. Just a couple of things. If you have questions, Mike will be stopping periodically to answer questions. Please write the questions in the question box that should be on your dashboard. That you can also click the hand icon next to your name, but it's preferable if you would write into the question chat box. Just to let you all know, I am at the National Council Conference in Washington. I'm hopeful that there will be no interruptions, but if you should get cut off, please just go ahead and log in again and call in again, and I'll try to deal with whatever technical problems arise. So with that, I'll let Mike take it over.
Great. Thank you, Shoshana. Good afternoon. So what we're going to cover this afternoon are topics that were raised by you folks, in terms of what I guess are some of the issues that you're facing and want to discuss. And those, basically, we're looking at doing an update on the revenues and some of the issues, not so much the numbers, although the numbers are in here, but primarily the issues that are associated with the different revenues. Talk a little bit about MHSA reversion, and then there were a couple of other fiscal issues that were raised that folks wanted to discuss. So jumping into the revenue update, it really hasn't changed much since we talked back in, I forget if it was the beginning of February, end of January. So what I'm going to cover today are the updates to 91 realignment, 2011 realignment, MHSA, and then there's been a little bit on the state general fund side. Starting with the 1991 realignment update. Really what I want you to focus on here, because I'm sure you've seen this slide before, is the source of the revenue. So we're talking about realignment. 1991 realignment is funded with sales tax and vehicle license fees. And so that's mainly what I'm going to discuss on the revenue side. And again, you probably have seen this slide before as well, talking about how the money is distributed on a monthly basis. And you've got a bunch of different accounts that you have to maintain for these different funding sources. And then lastly, any growth funds are placed into growth accounts for sales tax and vehicle license fees. So again, really just jumping into where revenues are to date, it's looking highly likely that we will meet the fiscal year 16-17 base. Year-to-date sales tax revenues are running at about approximately 4% higher than last year. VLF is even up higher. It's running about 8% more than last year. So there's a pretty solid chance, at least through the end of last month, end of March, that we're on track to at least meet our 16-17 base. Which means we potentially will have some growth funds, both in sales tax and vehicle license fees. But again, as I've discussed before, increases in social service caseload costs are the first priority for any sort of sales tax growth. And in fact, in 15-16, there was in fact sales tax growth, I believe, of about 57 million. But the social services caseload costs exceeded that level of growth, and so mental health did not receive any sales tax growth for 15-16. And so the real big issue here that I'm sure you're all aware of is the discontinuance of the coordinated care initiative due to it not being cost effective. And what that does is it's going to shift some of the in-home supportive services costs back onto the counties, which result in a huge increase in social services caseload costs in fiscal year 17-18. And the estimates are that this increase in-home supportive services caseload costs will be about $625 million in fiscal year 17-18. When you compare that to the anticipated sales tax growth for fiscal year 17-18, which is about $144 million, you can see that there will be insufficient growth to fully fund the increase in caseload costs. And given that it will continue to take time to catch up, meaning that unfunded growth in caseload costs will have first priority on the next year's growth in sales tax. At this point, I think it's highly unlikely that mental health will see any sales tax growth in the foreseeable future, given what I understand is the current approach to now taking care of these services. The one thing, though, the mental health sales tax base should not be impacted. So it shouldn't be where they would go in and take money out of your base in order to fund these increased costs. The other thing around this same topic is I have heard from you folks from various counties that the state has talked about various levels of a reprieve from meeting the requirement right out of the gate. And I've heard that it might be a small county sort of thing where you won't have to meet all the requirements, as well as I've heard that it wasn't a small county. It was for everyone would have a little bit of a reprieve. The thing I'm not sure is how that would look. I would imagine the state would have to kick in some money to help out with this growth. And so short of that, I'm not sure how there would be any sort of assistance or reprieve from meeting the requirement. On the more positive side, the growth in VLF does go to mental health, social services, and public health. And so we will continue to see growth in vehicle license fees, and we'll still receive growth in 91 realignment due to the growth in vehicle license fees. So that is pretty much it for 91. Just to give you the numbers, this again isn't really changed from the governor's budget back in January. The only thing is that I would, when you look at the growth in base for sales tax, I would zero it out for 17-18. For the current year, for 16-17, they're projecting a slight amount of growth available for mental health. The $4.5 million there for mental health assumes about $82 million in growth overall in sales tax, with the majority of that going to social services. You know, at this point, I don't know if I would necessarily count on that growth since it is so small, and any slight variation in the projections would wipe that growth away. So any questions on basically on this sales tax issue and the coordinated care initiative and the increase in home supportive services caseload costs?
There's no questions yet.
Okay. The other area where folks were asking, probably in response to the thought of having unfunded social service caseload costs, was to provide some guidance around what are allowed for the 1991 realignment transfers. And so, and I'm giving you the code section here, Welfare and Institutions Code section 17600.20 allows for the reallocation of funds among the accounts in your local health and welfare trust fund. And there's actually 5 accounts, but it exempts two of those, the CalWORKs MOE and there's a family services account that are exempt from being able to be transferred, which basically leaves social services, the health, and mental health. And so you can transfer funds among those three different accounts, but it's limited to no more than 10% of the amount deposited in the account from which the funds are being reallocated for that fiscal year. So if you were going to transfer money from mental health to social services, you'd be limited to no more than 10% of the amount that's in the mental health account. There are some, and this is the main statute that folks generally use when looking to move money between the different accounts within your local health and welfare trust fund. There are also two other provisions, which I've listed here, that can apply where you can move money. And the second one here could very well happen now with this, with the increase in social services caseload cost potentially exceeding, the growth amount. You also have the ability to reallocate an additional 10% from the health account to social services account for caseload cost increases. So if by doing the first transfer for mental health and health, you don't fully cover all your caseload cost increases, you can actually take an additional 10% from the health account as well. And then the third bullet probably wouldn't occur because this would trigger when social services has received excess funding over and above your caseload costs. You can then reallocate an additional 10% from social services to mental health and or the health account when you have excess social services funding in excess of these caseload costs. But again, because we're talking that you're going to probably see significant increases in your social services caseload costs, it's highly unlikely that that this would kick in. In any of these cases where you're moving money around, you've got to go through a public hearing, and you've got to provide evidence that the reallocation was based on the most cost-effective use of your available resources in order to maximize client outcomes. So given what we're talking about in terms of the increase in social services caseload costs, what you have potentially at your disposal for those of you who are social services folks would be first, you can transfer 10% from both the mental health and the health accounts into social services. If that does not fully fund your increase in caseload costs, then you can also transfer an additional 10% from the health account to cover those caseload costs as well. So you've got flexibility. Kind of the bottom line for mental health is, in addition to not seeing any growth in the sales tax, is you're probably going to have this pressure to transfer 10% over to social services if the discrepancy between actual caseload costs and the amount of funding is so great. I could easily see that happening. So any question on that? And again, if you want to, definitely take a look at the Welfare and Institutions Code section that I have listed here, and you'll see these different the different transfers that you can do.
No questions. Oh, actually, there is a hand raised. Hold on. Sharon Mendonça. I'm unmuting you. Sharon, you're on.
Yes.
You have a
Can you hear me now? Yes, I do. Can you hear me? Okay, good.
Yes.
So, Mike, you stated that you can move, and of course I'm familiar with this, 10% from health, from public health into HSA, and or 10% from mental health into HSA. Now, but you can also, based on this slide, shift an additional 10% if social services caseload needs are not met. So, in fact, could they take 20% from mental health or 20% from public health, or does it have to be?
Yeah, the most they can take
10 and
from
10
mental.
And then, mm-hmm.
Yeah, the most they could take from mental health is 10%. But
Okay.
you're right. For public health, if the caseload costs were not met, they could take 20%. Or I shouldn't say they. I said the county can reallocate 20% of the public health funds. But mental health is limited to no more than a 10% reallocation to social services.
Okay, great. Thank you for that clarification.
Sure. Any others, Shoshana?
Keep going. No more questions now.
Okay. So then moving on to the 2011 realignment revenue update. Again, the main thing to focus on here, you've probably seen this slide before, but just to reemphasize that sales tax is what funds 2011 realignment. And just like with 1991, for 2011, we fully anticipate, at least through the funding in March, that we'll meet the 16-17 base statewide. So again, year-to-date sales tax are approximately 4% higher. And in addition, because if you actually probably look at actually you guys wouldn't be able to do this because the percentage by county changed. I was going to say you could look at your allocations. Overall, the amount of funding in the behavioral health sub-account is up about 7%. And part of that is because the behavioral health sub-account now receives a little bit of a higher share of the revenues of the sales tax that comes in due to just the way the gross distributed. But you wouldn't see that on an individual county by county basis because they changed the individual county percentages. But in any case, we're definitely looking like the fiscal year 16-17 base will be met based on revenues that we've seen through March. Again, you should look at information notice 16-052, which goes through how the base percentages were determined for each county based on 1314 EPSDT approved claims by the county of service, 1314 drug Medi-Cal claims based on county of responsibility, and then also adjusted to include a $100,000 minimum for counties who had a small or non-existent drug Medi-Cal program, and then include the historical amounts for managed care, for the mental health managed care, for non-drug Medi-Cal allocations and drug court allocations. And then the balance was distributed based on the Medi-Cal enrollment in each county. And then there was also a hold harmless adjustment, so no county would be reduced by more than 15% over the 15-16 allocations. And again, as you've heard me talk before, the info notice itself uses a total dollar amount that exceeds what the actual 16-17 base amount is. And that's because the information notice was based on the May revised projections rather than what actually came in. And so what you're going to want to do is use those percentages from the information notice, not the actual dollar figures, because the dollar figures do not add up to what the true fiscal year 16-17 base represents. And then again, for 15-16 growth, there's $67 million that has not been allocated yet. And so one of the questions was, how do you determine, or how is a county obligated to determine the split in these different programs within the behavioral health sub-account based on the information notice or on any other sort of information? And the answer is no. The statute's very specific that funds in the behavioral health sub-account must be used to fund those things that you see there, which includes Medi-Cal, especially mental health services, the EPSDT, as well as anything basically related to the Medi-Cal, especially mental health and mental health managed care. And so it really is the county discretion how to allocate the revenues that you're receiving into that behavioral health sub-account between substance use disorder and mental health. Obviously, you have to balance a lot of your local priorities. You have to keep in mind a little bit on your local SAPD MOE, although again, the way SAMHSA looks at that is more statewide than on an individual county basis. But you want to keep those things in mind, but at the same time, you do have the flexibility to utilize these funds for any of those programs and in any sort of proportion that you want to use for those programs. So you don't have to use the percentage distributions that are shown in, for example, any of the older info notices that are used to establish a base. Are there any questions on that?
Ramona Diaz has her hand up. Let me unmute her. Ramona, you are unmuted. Do you have a question? Hello, Ramona?
Yeah, I'm not hearing anything.
Me either. Okay. Maybe that's by accident then. Other than that, there aren't any other questions.
And so looking at the revenues, this isn't any different than what we talked about, back in January or February when the governor's budget was released. These are the projections. And again, you see that behavioral health sub-account actually receives a disproportionately higher amount of the growth, which is part of the statute, because the first 200 million or the growth distribution percentages were different until 200 million was restored to child welfare, and that was met early on. So we start to see quite a bit of growth in the 2011 realignment. And so another question similar to the 91 side asked about what sort of transfers or reallocation of funds can you do with 2011 realignment. And Government Code Section 30,025, which is where all this 2011 language is, does allow for reallocation of funds among the sub-accounts in the support services account. And so the support services account consists of the behavioral health sub-account and the protective services sub-account, or basically the child welfare sub-account. And so you can allocate funds between those two sub-accounts, but you're limited to no more than 10% of the amount deposited in the immediately preceding year in the sub-account with the lowest balance. So whichever sub-account had the lower amount in the prior year, you could transfer 10% of that amount between accounts, or reallocate 10% among those accounts in the next year. As with 91 realignment, you've got to do it through a public hearing, and you've got to do the same sort of thing where you're demonstrating that the reallocation was based on the most cost-effective use of available resources in order to maximize client outcomes. There also is a section that I didn't even really know existed that allows the county Board of Supervisors to create a support services reserve sub-account within the support services account. And within that, the county can allocate up to 5% from either the protective services subaccount or the behavioral health subaccount to this support services reserve subaccount. And then the use of the funds in this support services reserve subaccount just needs to be consistent with both the requirements or either of the requirements in the protective services subaccount or the behavioral health subaccount. So what it sounds like to me, and again, I'm not familiar with this part of the statute, but it sounds like you can set up kind of this 5% sort of reserve that you can then use if you need it on whatever requirements you have that are consistent with what's in the protective services subaccount or the behavioral health subaccount. And I'm not familiar, again, with anybody doing this, and I was actually somewhat surprised to see it there. But it is in there, so it gives you the ability and some flexibility, again, with your behavioral health and your protective services subaccounts. So that probably totally confused you. I think the main thing to focus on is that you can do the 10% transfer, no different than 1991 realignment. So any questions on that stuff?
There's a question. Can you please explain how the state allocates 2011 growth to each of the counties? Is it the same method as the base? Please explain.
So it's somewhat varied by fiscal year in terms of how they've allocated the growth. And my understanding is, I think, CBHDA with CSAC is trying to work on a methodology for allocating the 15-16 growth. And I think it's trying to get at an approach. It's not the same as the base, but it's I think trying to get an approach that factors in both historical expenditures, which the base definitely does, as well as basically the need within the county, which is by looking at your Medi-Cal enrollment by the different aid code groups and risk-adjusted costs for the different aid code groups. But again, until, like I said, so far to date, we have not had a rolling base for 2011 realignment where the next year's base equals the prior year base plus the growth for that prior year. We have not had that occur on an individual county level yet. I think the intent is to get there, and hopefully that will happen potentially with the 17-18 base allocations, where it would consist of the 16-17 base plus however 16-17 growth is distributed. But at this point, it's not the same as how the base was set. Any other questions?
No more questions.
All right. Moving on to Mental Health Services Act. Again, here, the main focus that I want you to look at here is we've got the source of deposits into the State Mental Health Services Fund. We've got this 1.76% of all monthly personal income tax payments. So that's of every withholding payment to the state. 1.76% goes into the State Mental Health Services Fund. And then there's an annual adjustment, which is a true up based on the actual tax returns in what is actually earned by the fund compared to what was already distributed through these monthly cash transfers. And again, you've probably seen this slide where the amount that is distributed each month is based on the unreserved and unspent funds in the State Mental Health Services Fund at the end of the prior month. And so that's how you folks get the funds. Cash transfers are largest in months with quarterly tax payments. And then the annual adjustments are incredibly volatile. So, again, looking at where are we in terms of revenues, we anticipate the significant increase in distributions compared to last fiscal year. Nothing's changed since the release of the governor's budget in January. At least I haven't updated any figures. Year-to-date personal income tax revenues are running at about 4% higher than last year, which is consistent with the anticipated increase in cash transfers. And then the annual adjustment that was posted last July was significantly higher than the prior year. And so here you can see what those revenues look like. The one thing I would point out is that for fiscal year 17-18, that annual adjustment should be calculated by now, and I would imagine CVHDA has probably received a copy of the letter, or if not, there's definitely a letter from the Department of Finance to the legislature outlining what that actual dollar amount is. And so based on these revenue estimates, we've got the estimated component funding, which is the actual amount distributed to you folks. And this does factor in the ramp up or increased obligation of the fund for the No Place Like Home bond debt service, which isn't that much in these early years. But again, from looking at the big picture of this, I think 16-17 we're pretty much on track for that, that level of a little over $1.8 billion. And again, depending on how that annual adjustment looks for 17-18, we're probably somewhere around that same level of funding. And that's also then pretty much the projection for 18-19. So nothing really new on the MHSA funding there. Any questions on the MHSA funding?
No questions at the moment.
State general funds, again, nothing new here other than the very last bullet, which is that the state, assuming that the Affordable Care Act stays in place and the Medicaid program doesn't change, the state has set aside state general fund monies to pick up the matching requirements for the optional ACA Medi-Cal folks. It's not much in the current fiscal year, but gets to be more out in the budget year. So what that means is, and hopefully again you're aware of this, through the end of 2016, these are the folks that were 100% reimbursed through Medi-Cal. Well, that dropped to 95% for the current calendar year. It'll drop to 94% in 2018, 93% for 2019, and then down to 90% for 2020 and beyond. And the state, at least so far, has indicated they're going to pick up the local match for those folks. So from your perspective, it means that you'll continue to receive 100% reimbursement for the Affordable Care Act folks. Any questions on any of that stuff?
There's actually a question on MHSA, going back there. Could MHSA funding be used for a co-occurring disorder program funding SUD and mental health? Yeah,
so yes. I mean, but you've got to go through your stakeholder process with any MHSA program. It depends on the component and how you're trying to fund it. CSS funds are supposed to be used on seriously and persistently mentally ill folks. Prevention and early intervention, you've got a lot more flexibility with, as well as innovation. But if that's one of the needs that your local stakeholder process has identified, then in general you should be able to make it work. All right. So given all that,
Actually,
this is
there's
where,
one more question.
okay.
Is it part of realignment? How does the state pay that match for ACA? Please explain.
So I have no idea, but I would guess, I would assume, well, I don't want to assume. I would guess that they're going to pay it based on a claims basis, no different than when we used to get EPSDT state general fund monies. So that you submit a claim, if it's adjudicated at one of the ACA aid codes, you would receive a warrant for the federal share, and then I don't know if it'd be on that same one. It'd probably be a separate warrant for the local match, but I would think it would be based on approved claims. Is how those funds would actually go to you guys at the county level. The other state general fund monies, I'm going to guess most of these are going to be allocated, but I do think the ACA would be based on actual claims, although it might be based on enrollment. But I haven't heard anything. And in fact, I mean, these are services, you should have started seeing payments theoretically for services provided after, January 1st. So anybody who has submitted a claim for services provided this January or February, I would hope you'd start to see the payments for that. But I haven't heard how they're going to actually get the money to you folks.
Another question. Why are the numbers on the MHSA estimated revenue side different from the estimated component funding?
Because, like I said, so the state carves out 5% for administration, and then there's also a reduction for the No Place Like Home debt service. But in general, the majority of it is just state administration. So not all the money goes to the counties. Any other questions?
No more right now.
So, there's been, I guess, more robust discussion around reversion lately within the MHSA. Welfare and Institution Code does specify that funds must be spent within a certain time period or returned to the state for reallocation back to the counties, not for just whatever the state wants to use it for. And it's specific that 3 of the components, CSS, PEI, and innovation, you're supposed to spend within 3 years. And then 2 of the components, workforce education and training and the capital facilities technological needs, those must be spent within 10 years. And then funds that are dedicated to the prudent reserve are exempt from reversion. So the Mental Health Oversight and Accountability Commission issued a report titled Mental Health Services Act Fiscal Reversion Policy Reconsidered, Challenges and Opportunities. Provided a link there. I would imagine quite a few of you probably participated on the conference call that occurred, I believe, a week ago. I was not on that call, so although I did hear it was fairly positive and folks were open to some of the discussion. What I saw in the report, just looking at it real briefly in terms of their recommendations, they're talking about recommending for the legislature and the administration to look at resetting the reversion policies, and they come up with 3 different approaches that they could potentially do that. One would be to hold counties harmless for reversion prior to whatever this restart date is. Another would be to allow counties to retain a portion of their reverted funds and return some of them back to the state. And then the third that they talk about is holding harmless for a specified time period. So funds allocated prior to 12/13 or something like that, you didn't have to worry about. So they didn't really say which one of those they recommended, but they did recommend that the state look at resetting reversion policies. The one thing that was somewhat interesting is that buried in their write-up is that they're proposing that the interest income that you earn at the local level should also be subject to reversion, which I thought was somewhat interesting. It also, in the report, they recommend extending the reversion period from the 3 years for CSS, PEI, and innovation for small counties. They suggested that it go from 3 to 5 years, given some of the challenges faced by small counties. My understanding is on the call that some of the larger counties were not so open to being excluded, indicating that they also have a lot of those same issues, and any sort of extension of the reversion period should apply to all counties. They also recommend that DHCS either develop regulations or guidance on how to revise or correct the annual revenue and expenditure reports, since a lot of that has been very unclear throughout the various years that you folks have had to submit the revenues and expenditure reports. And then the one thing that, again, I thought was interesting was that they recommended creating a state-level reversion fund, where any funds that revert, they would go into this specific fund. They felt that this would improve transparency in terms of the reverted funds. They feel that this would enhance the incentive to spend funds, use it or lose it principle. I don't know if having a separate fund really does that, but in any case. And then lastly, they want to dedicate the reverted funds for unmet need and on specific projects. And so it would be a pretty significant change to the Act in terms of what the Act says now is funds revert and then come back to you guys. This would say the funds revert, and then the state would figure out basically how to dole them out based on how unmet need is defined. So, I'm not sure what will come out of it. I know that there is some legislation proposed to do some of these things, especially the separate fund and the separate approach to having folks apply basically like a grant for the funds. I don't know where that is, or we're pretty early, I think, still in the legislative process, whether that will go through. I'm not sure also whether any of the two infrastructure components, which is the capital facilities information technology and then the workforce education and training, if any of that was really discussed, or if the focus was just on CSS, PEI, and innovation. And so just to make sure you folks are aware, the way it is written now is that capital facilities information technology funds are supposed to revert at the end of next fiscal year. So those initial funds that the state doled out specifically for CFTN are, if you don't spend those by a year from this June, they potentially will be subject to reversion absent any of these changes that the OAC has recommended. And then with the workforce education and training funds, there were actually two different pots of money that were distributed. There was $100 million distributed first, and then another $110 million distributed after that. The first pot of money is supposed to revert this June, and then the second pot of money would revert next June in 2018, again, absent any changes based on what the OAC has proposed. So are any questions on the MHSA reversion? It just seems like there's a lot. Yeah, go ahead.
Rose Bullock has her hand up, so let me unmute her. Rose, you're unmuted. Do you have a question? Hello?
Yeah, I'm not
Rose,
hearing
do you have a
anything.
question? Me either. Okay. And then there was one other question. Can funds for MHSA CFTN be encumbered and considered spent and not be reversed?
So, so the state, I mean, again, it's all through these info notices. The state has said you're supposed to apply expended consistent with the state controller's office guidelines for counties on what constitutes an expenditure. They have said that funds that are encumbered do not necessarily represent an expenditure. But that said, you know, I think there's a gray area if you actually move those funds out of the local mental health services fund to, you know, to another agency, and that may be considered an expenditure. But I think they've been pretty consistent saying if you enter into an agreement, that doesn't necessarily constitute an expenditure. So you actually have to receive a good or service to incur the expenditure. And so that just encumbering the funds wouldn't be sufficient. But again, transfers, which is what the state did with the initial $400 million Cal HFA, MHSA housing program, where those funds were not subject to reversion, they said because they transferred it out of DMH into Cal HFA. So, and I believe they've applied the same, although I could be wrong, I believe they've applied the same sort of concept to some of the Cal Mesa and the statewide projects, that once those funds were transferred to Cal Mesa, they weren't reverting. Any other questions?
Okay.
All right, then moving on, there were a couple of issues that folks asked about. It kind of just didn't really fit with some of the topics. I was going to take my best stab to try to discuss them. One county identified with their fiscal year 10-11 EPSDT State General Fund settlement calculation where there were some errors. And it's pretty clear when you look at it, the initial settlement calculation didn't correctly calculate the 10% local match on growth that would have been the county's responsibility. So this was actually a benefit to the county that the state made the mistake. They then subsequently went through an audit, and the audit actually didn't find this error and in fact said that the state owed the county money. Then after that, the state came back and even after the audit said they redid the settlement calculation and corrected their error and showed a different amount. The thing that this revised settlement document didn't do was, number one, take into account if the county had already had those funds recouped from their first notice. It should have been reflected in the revised number, meaning if the state's already recouped those funds, they'd be recouping them again. And then the second thing is the revised settlement notice didn't take into account the audit. So, and then actually, to be honest with you, lastly, I would think after you go through an audit, I'm not sure the state has the authority to go back and do sort of correction. So in any case, I think the main thing is make sure you're looking at your 10-11 EPSDT settlement. And if you get one of these revised settlements, you're going to want to research whether they had recouped any funds from your initial settlement. And if they did, make sure that they don't recoup those funds again, because it should show the net difference, not the amount as if it was never recouped, if they in fact did recoup it. And then there was a question on the Medi-Cal payment tracking on the DHCS MedCC library website. there is a direct services table that the state publishes. They haven't updated that since last November. So gosh, 5 months now. And so one county, and I'm going to throw this out to you folks, was wondering how counties are tracking payments and whether you guys are emailing the HCS directly for updates on this table or something else. I don't know if folks are having issues with this or if anybody's been looking at it that closely, but I'd be interested if anybody wants to raise their hand and say how they're tracking Medi-Cal payments at this point. And if not, this also is probably something you guys should talk about at your Financial Services Committee meeting under the county to county time. And then there was a question on the AB 1299 and how is the county of residence going to get compensated because you're going to see an increase in services for various counties, and really that should be addressed, I would think, through the behavioral health subaccount growth allocations. And if those growth allocations feed into a rolling base, then it de facto gets molded into the base. The downside is, it's several years out. So in order, the county, the host county, would basically have to cover it until the growth got caught up based on data, which I would imagine would always lag at least 2 to 3 years. But again, that is something, again, I think you folks need to talk about when you're looking at how to set up growth allocations and the rolling base for the behavioral health subaccount. You can also, there are counties that bill other counties for various things, and you could do that as well. And then kind of the flip side is what's going on with drug Medi-Cal, where at least the fiscal year 16-17 behavioral health subaccount base allocations are based on the county of responsibility. So here, a lot of counties are getting asked by providers to enter into contracts with providers and with folks that are outside of their actual county. And so the question is, are there discussions on this issue? And how are folks dealing with it? And to be honest with you, I'm not sure. I do, again, believe that you can deal with a lot of this through the behavioral health subaccount and the allocations. So that would be the suggested solution. But in the meantime, I think you're kind of forced to enter into the agreements. And this county also said that they anticipate significant increase in costs to opt into the ODS waiver, and this is after having their 2011 behavioral health subaccount allocation reduced. So I agree, these are all things to take a look at when you decide whether you want to opt into the drug Medi-Cal ODS waiver. And so those were the issues. I don't know. I think Shoshana might have lost audio. And I don't have. Let's see. I don't have the ability to see you folks. So it's a couple minutes before 3, but I think given the audio difficulties we're having, we're just going to go ahead and wrap it up. And thank you for listening, and hopefully this was helpful. Thanks. Bye-bye.